Good evening, everyone. It's IPO season on Wall Street. The number of companies going public is soaring, and investors are salivating to get a taste of Candy Crush. King Digital Entertainment, the company behind that popular smartphone game, is issuing its initial public stock offering tomorrow when it begins trading on the New York Stock Exchange, and it's expected to price tonight. When a company decides to go public, it's a sign of confidence in the markets and conviction that investor interest to own a piece of their business is high. So with the rush of companies staging IPOs, is this the right time to go public? And does it make sense for investors to add these newbies to their portfolios? Seema Modi reports.
An upbeat economy, rally on Wall Street, and a string of successful listings have provided the ideal backdrop for private companies to go public. So far this year, 53 IPOs have come to market. But the recent IPO craze and the strong performance of newly listed companies has some traders wondering, are we in an IPO bubble?
A bubble is just about ready to pop at any point. We're in a balloon at this point, and when an underwriter makes a misstep and they get too aggressive with the valuations and the investors say, no, not with me, not this time again, there's going to be an immediate change. You'll get revaluations that will come down dramatically like they have been doing with some of the drug stocks.
According to IPO Capital Markets, of the companies that have gone public this year, only 13 are trading below their offer price, and 7 of those are from the biotech and pharma space. Another red flag is the strong performance of some recent IPOs, despite the companies being unprofitable at the time of their IPO announcement, like Intrawest Resorts, Akebia Therapeutics, and Castlight Health, according to S&P Capital IQ. Lastly, the huge opening returns of tech IPOs have made some investors nervous. Renaissance Capital says tech IPOs have been averaging a first-day pop that is more than twice that of the average IPO this year. But experts say be cautious. Names that have moved up so fast have farther room to fall. For Nightly Business Report, I'm Seema Modi.
And our guest tonight says the IPO market is in the initial stages of a correction. She's Kathleen Smith, co-founder and chair of Renaissance Capital, which Seema just mentioned in her report. Kathleen, welcome. Good to have you with us. You heard David Menlo a moment ago describe the IPO climate right now as a balloon, not a bubble. I'm not sure that's not a distinction without a difference. Is that how you see it? Is that what you're saying?
Yes, we think there is some IPO madness in the market currently, and particularly with the biotech stocks and the fast-growing cloud technology stocks.
So, people look at the IPO price, how an IPO does on the first day of its trading, and then how it does, a little bit time later. Based on that gauge, how are the companies that have been going public this year doing so far?
Well, so far this year, the average IPO first day of trading is up 22%. That is much higher than the norm, which would be about 13 to 15%, although it's not as high as it was in 99-2000 when many of those first day pops were over 50%. But the 22% number that we're seeing currently is just not a sustainable number. So we don't expect to see that continue, and there'll be some adjustments to pricing to put a little bit more reason into the market.
I guess those first day pops are the things that are so eye-catching, Kathy, but when you look out 6 months or a year, how do IPOs as a group typically do?
It's hard to know what typical is. The important thing is the market works well when investors make money beyond the first day pop. And if you look at a basket of newly public companies in, for example, the Renaissance IPO ETF, in 2013, that index that it tracks was up 54%. That's dramatic, and those returns we hadn't seen in a long time. So far this year, that ETF is up almost 3%. It's ahead of the S&P 500. But it's fading a bit. We can see that those very big returns that we had in 2013 they're there, but not as dramatic as we had seen before. Those returns have to stay positive relative to the market to have the whole IPO cycle work. So we're looking at that to say if that fades, there needs to be some adjustment in pricing to get the market to work for investors.
Kathy, I'd like to get your take on a couple of IPOs that there's a lot of excitement about. And one of is this that we just mentioned, Candy Crush. And the other one that a lot of people are talking about is Alibaba, the Chinese big internet company that may go public sometime this year, maybe in the summertime. What's your take on these? Are these stocks that investors should take, serious look at and put it in their portfolios?
Well, both of them have some amazing things associated with them. Candy Crush, a company that has running at about $2.8 billion in revenue, just coming from nowhere on this one very popular Candy Crush game, and a profitable company, and a worry that could this be a one-hit wonder, and what kind of revenue would you project going forward? So an amazing story that needs to be priced correctly, and tonight's pricing will tell a lot about the investor reception of that. In the case of Alibaba, this one could be the largest IPO ever, and in fact a major company, US-listed company, maybe at one of the top 25. And that means that that company, it'll be a very big offering, but that company will probably end up in major institutional portfolios and possibly in the S&P 500 over time. So that is going to be one worth watching.
All right, Kathleen, thank you very much. Kathleen Smith, Renaissance Capital.